Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So as you know, around this time every month we look at a couple of companies that are undervalued that you could potentially add to your portfolios for the month of September, and that's what we're going to do today. So I've got 6 companies in this video that are high quality businesses. They are all undervalued at this point in time according to Morningstar valuation, which I use, and at the same time they have a wide economic moat and so on. So we're going to talk about these companies. We will analyze each one of these companies, their financials, and then I'll tell you at the end what I would be doing, because I do own some of these companies in this portfolio. As you can see here, just before we do that, by the way, we're just going to talk about the general what's happening in the market, because as you can see here, the portfolio, I've not sold anything, but it has actually come down quite a bit. I think we are the June low. I think around June time we were around the same basically value in terms of the entire portfolio. So it has come up quite a bit at some point. There we go. So that was the highest I think it's been so far, and then boom, right now is down. So either way, it doesn't really make any difference for me for what's happened for the last 3 months. But it is interesting because what we see now is quite a bit of a volatility in September. September is basically on record is the worst month for the stock market. Okay, I think is for the last 3 years, if not 4 years, I've seen it basically go down at least to 4%, if not more. I'm talking about the entire S&P 500. October is kind of okay, and then November onwards things pick up again. So it is normal. It does happen. There's election that's coming up. Of course, we're waiting for the Fed to come out and just say, okay, we're going to cut the interest rate by this much, and then that might help some of these companies, especially dividend paying companies and so on, companies that are on the growth side of things. So we will see what happens overall. As always, we don't have to panic. We don't have to worry about anything. We just need to look for high quality businesses that we can add to our portfolios. The month of September is the month I actually spend quite a bit of money. Like, I don't know if you've noticed, in August and July, I have not actually purchased much in terms of adding that £1,000+ of buying stocks. Basically, I've bought here and there a little bit, but not a lot. And I was trying to accumulate as much cash as I possibly can. And to be fair, I couldn't find any basically of these companies that were really undervalued, a very, very good position. And what I'm trying to do is build of course, a position. Once it's the full position, then I'm not going to add to it if it's not going, if it has not come down quite a bit. And it's basically, if I think in the long run I need more of that company and it's got the price range that I'm looking for, then I'll buy it. So that has not happened yet. So September, inshallah, we might see that. And actually some of the companies that I'm really interested in the long run have actually come down quite a bit, and potentially in the next few weeks you'll see me buy more, inshallah. Anyway, before we get to the actual companies that we're going to talk about today and the markets, I would really appreciate if you can join us at the Patreon account. It keeps us going, inshallah, and it keeps us helps us, to be honest, reach a lot more brothers and sisters out there, to help them, of course, join on this journey, inshallah. Now, the fear and the greed side of things, it's actually kind of neutral right now. And when you look at the S&P 500 for just the last 5 days, as you can see, it's down about 2%. The Dow Jones about 1%, the Nasdaq is about 3%, and the FTSE for some reason is actually down over 2%, which is absolutely crazy. Now, for the 1 month, okay, things slightly changed. We're up 5%, 4%, 4.5%, 4.5%, and then the FTSE about basically 2%. Now, for the last 6 months, that's when things slightly changed: 7%, 5%, 5%, and then almost 7%, which is nice. But a year to date, so since January, we're up about 16% in the S&P 500, 8% for the Dow Jones, and the Nasdaq 14%, and the FTSE 100 about 4%. For the 1 year, it's a slightly different ball game, 23%. So we are not in a cheap kind of territory yet. Hopefully that will happen in the next few weeks. We might see more of this. If we see maybe 3%, 2 to 3% decline every single week, maybe in the next few weeks, things will start to change. People will start panicking, people will start selling, and that's when we look for opportunities, because we don't really care what happens this month. Like, I promise you, you will not be able to tell me what happened this time last year, right, about the stock market. This time next year, we will not be talking about September 2024, I promise you. So for that reason, you just continue investing in high quality businesses and don't worry about what happens in the long run. I've got a few more videos coming up in basically the next 24 hours with regards to the portfolio. So I will be giving an overview of every single holding that I have, whether I'm going to sell, basically buy more, and so on. So I will give you more information on that, inshallah. Now, we're going to look at these 6 companies. Okay, I'm going to go over as quickly as I possibly can. And the things that I want you to pay attention to is the moat here. That is basically, this means that these companies have a competitive advantage over their competitors. Your profit margin, return on equity, and return on invested capital. These companies are doing amazing in that, on that basically side of things, as well as they are all undervalued at this point. And the first company we're going to look at today is ASML. ASML are basically right now is actually discounted about 20% according to Morningstar, which is absolutely crazy. What I normally tend to do is I actually use the valuation, but I also make sure that I have 10% for myself in terms of margin of safety. So I would say 20%, so minus 10, of course, so that 10% discounted. For me right now, this company is 10% discounted. That's basically what I would do. But then on top of that, I always make sure if I own the company, if I don't own it, then I can start a new position maybe. If I do own it and I'm up, say 30%, 40%, then I might not touch it at that point. I might wait for a better opportunity. Maybe it will come back down again, another 5 to 10%. And then when I can't resist anymore, I'll buy it. The reason I said that is because there are other companies in my portfolio that are down quite a lot. I rather basically average down instead of averaging up, especially with 30% with these companies can be quite volatile. As you can see here, the market cap for this company is $315 billion. They do have a wide economic moat. Right now, they're trading about $800 per share, but they are saying $990 per share is where the price should be. They do have some dividends. They have been increasing about the last 14 years. You get paid $6.65 of every share of this company that you own. That dividend is safety. Last 5 years in terms of revenue, in terms of the EPS, they're both doing absolutely amazing. Profit margin, return on equity, return on invested capital, absolutely wonderful to see that. $3 billion of free cash flow right now, 24% total return in the last 10 years, and they're expecting to grow up basically the earnings about 58% this year, next year, and 22% after that for every single year, which is absolutely huge. So this is the reason why I really like this company, and the fact that it's discounted right now. This is absolutely a high quality business. As you know, they monopolize that sort of a lithography side of things. I don't think there are that many companies out there that can compete with this company, especially with the type of products that they have and how expensive their products are. One single machine of this company costs over 300 million pounds, which dollars, whatever, which is crazy. The next one is the big one. So this TSMC buys everything from TSML, because they basically, in order to basically make those chips, they need the machines that ASML has. And look at this company, 23% discount right now, $213 per share is where they think it should be, $163 per share. Unfortunately, if you live in the UK, you might not be able to buy it through Trading 212, but for some reason, don't ask me why, okay, I've managed to buy this company on my Interactive Brokers ISA account for the family account, okay. So I don't know. I really don't know how that happened. I did buy the US ticker version, so rather than the Taiwan one, and I think the one that's available on Trading 212 is the only Taiwan version of this stock. I'm not sure, just double check that. 733 billion market cap. They are currently trading $163 per share. Dividend 1.5, which is quite nice. They do increase it here and there. Okay, sometimes they don't bother. And you get $2.47, and the safety is 62% right now. They are basically doing well when it comes to the revenue side of things and EPS side of things. Profit margin, return on equity, return on invested capital over 20 something percent. Free cash flow right now, $22 billion. Total return in the last 10 years, 23%, which is absolutely huge. Growth estimate next year, 26%, 22% after that every single year. Look at these two companies, very, very similar, 23% discounted. I really like those two companies. If you're basically into semis and you don't want to buy these individual stocks, you can also buy the ETF, okay? That ETF, the SMH ETF, that you're better off buying that. There's a UK version as well if you don't want to take that risk of owning those individual stocks. The next one is Nike. If you like this space, this is one of the companies that almost every single household has a product from this company. Especially if you've got like little kids or teenagers, whatever, 121 billion market cap, wide economic mode, $80 per share right now. Dividend is absolutely fine. 22 years of increase in that dividend. Annually, you get $1.48, and safety 99%. And the last 5 years, basically, they have been growing their revenue as well as their EPS. Now, in terms of profit margin, it's about 11%, but the return on equity and return on invested capital are absolutely amazing. $6.6 billion of free cash flow. Total return of the last 10 years, you would have received about 8%. Growth estimate next year 15%, 5% after that for every single year moving forward for the next 5 years. 35% discounted right now. It have bounced back a little bit, and then I think kind of went back down again. So this company has been basically neglected. I feel like this is one of those companies that have not had a great basically couple of years. So we will see what happens to $124 per share is where they think the price should be. The next one that we're looking at today is Hershey, one that I actually own in my portfolio. 40 billion market cap, wide economic mode, $198 per share. 6% discounted right now. $210 per share is where they think the price should be. The company has actually really good dividend. This is very, very safe. Latest increase with 15%, and the 5 years about 10%. They have been increasing that dividend for 14 years in a row. The annual payout $5.48, safety 80%, and they are doing well in terms of revenue, in terms of EPS over the last few years. Look at it here as well. Profit margins of almost 17%, return on equity of 48%, and return on invested capital of 26%. $1.3 billion of free cash flow. Total return the last 10 years, we look at about 10%. Right now, this is basically not doing well for the next few years. They're expected not to do well at all. Margins are kind of squeezed a little bit because of the prices of cocoa. So we will see what happens with the company. But as you know, if you've been with me for the last few years, we've seen similar companies bounce back easily. I can remember Qualcomm when it was actually predicted to have a negative 5-year return, whatever estimate for the basic growth side of things. And what happened the following year, things slightly changed and things cleared up, and right now is basically growing massively. So 6% discounted right now. We'll see what happens to the company, inshallah, in the long run. Hopefully it will bounce back. Another one that has been left for dead this year is UPS. I do own this one as well. $127 per share right now, and they're expecting about $150 per share, about 15% discount right now. This is one of the companies that have struggled a lot, and my only concern for this one is actually the fact that Amazon basically delivery is actually growing in a lot of the US states, whereas in Europe and other places it's not as much. But we will see what happens with this company in the long run. I don't think they're going to run out of business anytime soon. They have basically, in terms of margins, they're absolutely amazing. In terms of free cash flow, they're doing well. They've got about 6% total return in the last 10 years. Right now, they're expecting the earnings to grow about 20% next year, and then 3% after that. Now, this is the type of company that basically grows about, let's say, 5 to 10% every single year. So I didn't expect this to be a high growth, but the dividends are absolutely amazing. It is very safe. $6.52 is what you will get, and it's safe 69%. So we will see what happens overall. Next one is NXP Semiconductors. 60 billion market cap, wide economic mode, $236 per share. Now, in the discounted right now by about 26%, $320 per share is where they think. Right now it's about 236. They do have some pay dividends, which is quite nice. They have been doing that for the last 5 years. They've increased about 52% in the last 5 years, which is absolutely amazing. You get over $4, and 60% is the basically anything about 61% and higher is safe. So right now is basically on that line of like just safe. In terms of EPS, in terms of revenue, so revenue is about 7% in the last 5 years, compound annual growth rate, and EPS about 78%. Now, profit margin, return on equity, and return on invested capital, absolutely amazing. $2.7 billion of free cash flow. They've given you about total return in the last basically 10 years of what, 13%, and they're expecting the earnings to grow about 14% this year, next year, and 10% after that for every single year. Now, as you can see, all of these companies are, apart from this one, double digits in terms of their discounted values. Now, you always have your margin of safety, which whatever that is. If you think these companies are very volatile, maybe do 15%. And if you don't own it, of course, then you can start a new position if you want to. And of course, do your own research. I'm not a financial advisor at all. So yeah, they seem really like solid businesses, wide economic mode. They are growing fast, a lot of them, and they are discounted right now. So we will definitely get enough, opportunities inshallah in the next few months. So we will see what happens. Let me show you in terms of Sharia compliance side of things. Nothing to worry about any of these companies. You can pause the video and have a look at that. Let me just quickly share, just be honest and transparent with you guys. As you can see, this one, I think I was up almost basically over £1,000, but it has come down quite a bit, as you can see, ASML. So what will I be doing? I'm gonna wait because I'm up about 19%. If it comes back down a lot, then potentially I will be adding to it, and there's no two ways about it. I've trimmed it before when it went to basically too high, and I wouldn't mind buying it if it comes back down again. Hershey is another company that I actually basically, I'm not buying it right now. I'm just gonna leave it. I bought 40 shares. I think I've got full position, but if it comes back again, back down a lot, then I might look into it. And what else do I own from this list? Let me just have a quick look again. Oh, this one I can't show you because that's in the family portfolio. The final one I want to show you is UPS, and UPS, as you've known for the last whatever years, I'm down about 27%, but that does not worry me, and I think I would be nibbling, just adding a little bit here and there wherever I can, because my average is actually just to be honest, transparent with you guys, let me quickly show you my average. So my average is $161 per share, and right now is 127, so that's probably why I would be buying more. And my average for this one here is $604 per share, and my average for Hershey is $186 per share right now. So yeah, September might be a bit crazy, but it gives us an opportunity to add to high quality companies into our portfolios, inshallah. I hope you enjoyed this content. If you are, please like the video, subscribe to the channel, of course join us on the Patreon account where you get access to a lot of these things. And you know what, I've been posting quite regularly about entire portfolio, so I've already posted the portfolio updates and all of that stuff for the community before I post it on YouTube. So if you want to join us there, will be really helpful, inshallah, and it would definitely help the channel because we do have a lot of subscriptions for a lot of basically software that we use. So let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.